Good evening and welcome to tonight's webinar. It's member-only content where we look at ASX investment opportunities in review. The advice provided this evening is general advice only. Investor Signals provides a broking account service where we provide a combination of model portfolios across the ASX and the US market. If you'd like to know more about the broking account, please call me on 1300 614 002. The table below there captures the 5-year average returns from following all algorithm signals across ASX 100 shares and US S&P 100. We'll update those performance statistics at the end of this quarter. The services that we provide are research, which is our subscription service, a private client broking account where the broking account's established in your name or your company or trust name, or a managed fund, which is a unit trust where investments are pooled with other clients. If you'd like to know more about our services, please contact me on the office number. And just a reminder, if you're joining us for the first time this evening as part of your 30-day trial, you can become a subscriber to the technology for $1,320 for the year. If you'd like some tuition on how to navigate or set up the model portfolios, call me during the daytime on 1300 614 002. The market this evening, now we've had some interesting developments. I'll start this evening by going through what's gone on to the blog in the last 7 days. Then I wanted to cover the ASX 50 tonight and conclude with a review of the ETFs that we're focusing on in the market at the moment. So to access the blog from inside the member area, simply click on the news button. Loads up the most current posting to the top. You've got your recent posts down here on the right. This evening we're just going to scroll through this. So the signals are posted. If you haven't already taken notice of these, it's always worth just sort of as a minimum skimming through these. These are not necessarily all ideas that you have to take action on, but it's always interesting just to see what's being flagged. From that, TPG now probably getting back up to near a resistance level, but the important pattern in the market here was captured in this post this morning, and in large this relates more to people that are looking at the market from a trading or a shorter term perspective. So we know that the index has been making higher highs and higher lows. It's been a bullish pattern. Any sell-off over the last 12 months has been relatively shallow. If we go back a week, there was a lot of negativity in the market. The market was under pressure, but there is this pattern of the buy on the dip happening. So if we look at sort of what the support structure is for this rebound in the market, there was buying off the lows there last week, and then now what we've got, I've shuffled a support line in here roughly around 7,330 points. If we were to see the market reverse back down through that, the short-term indicators roll over, then we'd probably be looking at something that's more a continuation of this downtrend. But given the pattern that we've seen where the market is buying up these shallow dips, for the moment we're willing to run the support line up tight under both Thursday and Friday's, that's Friday and today's session lows, which gets you to roughly that 7,330 points. And if we get a reversal of that, we start to be a bit more cautious, but for the moment we're starting to add some positions back into portfolios again, and we'll have a look at what they are. IAG is one of those examples where this stock switched to algorithm buy signals. From a fundamental standpoint, I can see an environment where 12 or 24 months down the track IAG begins to develop an improving uptrend, and we may be at the early stages of that higher low formation occurring there in IAG. BHP, we've added to our existing BHP position at the end of last week, and at around this sort of roughly $38, $39 level, comfortable just adding some further exposure to that. You may recall that we entered BHP in a staged approach, small allocation, and then willing to add to it. So we're just at that level that we're adding some to that at the moment. Interesting, we've had the sell signals in the energy names, and we'll take a closer look at that as I toggle through the top 50. But we're sticking with Woodside in particular for the moment, and I'll explain more about that when we get to the top 50 charts. The iShares S&P 20 So this is the code's ILC. This captures a diversified exposure to the top 20 companies by market capitalisation. We've had an algorithm buy signal, and there's an opportunity to think about that. Obviously, you're getting a fairly large weighting to the resources. The banks are pretty close to full value, but there are, if you're looking to balance a portfolio with a broad instrument, the iShares S&P 20 is one way to do that. Amcor, my post here is really just to suggest that you add this to your watch list. The stock's corrected from $18 down to $16. We're likely to see an algorithm buy signal soon. But at or near this $16 level, I think Amcor's getting back to somewhere that's fair value. There's another iShares ETF. This is a diversified dividend opportunities fund. And if you'd like to know what allocations are in that fund, I've posted that at the bottom there. Again, one thing to keep in mind that we're seeing in the market, and we'll pick this theme up as we toggle through the top 50 companies, is that interest rates have moved up a little bit in the US. So there seems to be a little more expectation that inflation is rising. You've seen the 10-year yields push up. What that's meant is money's gone into banks and resources, or banks and energy in particular. And you're starting to see a little bit of a softening in the consumer staples and the healthcare. Now, that's not a long-term trend that's in place, just meaning over the last week that's been sort of a theme. So if you're looking for an understanding as to why some of the healthcare is weak and energy strong, that interest rate environment helps explain that. Coles, we think that this is getting down to a level where, again, you might look at entering this in two stages, buying on the top end of that band and also adding to the position at the bottom end to get sort of a blended price there. Again, don't be overweight these consumer staples at the moment. We did see a slight pickup in some of their cost story in recent months, and I think that'll be a theme that continues into the full year results over the next 12 months. So they are attractive from a defensive dividend standpoint, but I'm not sure that they really rally up and take out these highs unless we really got a weaker economy and those interest rates moving down in the US. So Coles, have a think about that if you don't own it. I'll cover more on that as we get into tonight's recording. As I mentioned, banks and energy are where money's flowing into at the moment. So just as an alternative to the Aussie banks, if you're looking for a trade or if you just want exposure to international banks, the Global Banks ETF, we cut that from portfolios a few weeks back, but just highlighting that it's back on support, and if you're looking for exposure, that's one way of doing it. We have added a small amount back in. We cut it really just as a risk management, raising cash while the market volatility picked up. The food ETF, fairly defensive ETF allocation here, but one to have a think about. It's a beta share product. If we go through, the iShares I've already covered. The global energy, so just an alternative to Woodside. So the fuel ETF, so that's under the ticker fuel. Again, gives you an idea there of what you're getting exposure to. US home sales in the prior weeks have been talking about seeing a slight softening. Now we've seen Boral correct. James Hardy may be rolling over slightly, but certainly not selling off. So are we at a stage where we see a little further correction in some of these housing-related stocks? So we continue to track that data flow out of the US. IAG's been a new signal, so I touched on that earlier. NAB's been added into the model portfolios. VentureX is more of a speculative. This is an explorer, not a producer. Copper company over in West Australia. I don't often comment on these, but there's a few that are creeping in on the radar, which I'll just share with you via the blog and upcoming recordings. iShares Asia 50 ETF, still my preferred way of getting exposure to top 50 companies in Asia at the moment, corrected from 130 down around 110. Zip, I think this is a growth opportunity in the Australian market. So if you're looking for something that could deliver significant returns, obviously taking on higher risk, but Zip's moved into India, and in general, I think sort of these buy now, pay later companies are becoming more on the radar of larger tech companies looking for bolt-on acquisitions. So we may see down the track Zip acquired by a larger company. Market direction. So here we were a week ago. So we had a pattern developing last week where the market had broken down and it was trading below that overhead resistance. This is the S&P 500. We've now put in a low and it's rallied back, and at the moment back above the 10-day average, and we'll take a closer look at that. So there we were last week, fairly deep sell-off. And as a consequence, I became cautious on CBA, NAB, and some of these other names. But what we've seen is money flow into energy. Obviously, we remain long energy. It's been one of our preferred allocations. And we've added a small amount of the bank position back in, but still remain a little bit cautious on ultimately whether earnings can continue to support and push the market higher. And there we are, back through to last week's webinar. So this evening I'll start with a look at the S&P, the Nasdaq and the Dow, then I'll move into the top 50 and finish with the ETFs. So quickly, just to touch on the Nasdaq, as I mentioned, similar pattern to the XJO. We've had the sell-off. The market looked heavy below the moving average, and we've had a strong rebound. And when we look at the action there last week, we've got support in the Nasdaq. So as long as it stays above that, the short-term indicators remain positive. We're back in a risk-on environment for markets. The next major risk event is probably something around the 10th of October as we start to see earnings come through and whether they can live up to market expectations. But right at the moment, that's the way to think about the market, that the buyers are back in control and shuffle the support up under those lows of last week. The S&P, very similar pattern, was below the average, rallied back up. So we go from sort of thinking about it of overhead resistance to shuffling this support up, and as long as it stays above that level, the uptrend's in place. And the XJO, similar pattern, rallied off the lows at around 7,300. There is the support. If we're to see that reverse back down, get a little bit more cautious short term. Alright, so let's go through the top 50 and focus on what stocks are in the top 50 model, and then I'll conclude with the ETFs. So I get the percentage gainers to the top, organise it so we're looking at the buy signals first. CBA, under algorithm buy signals, I've shuffled the support up there to around $100. A reversal back through that would be negative. Fortescue, we've seen iron ore rally from roughly around $100 a tonne back up to around 118, and we've seen some buying interest pick up in the iron ore stocks as a result of that. ANZ is in the model portfolio, as is Macquarie, one of the better performing financial services stocks. Rio added this into the model, so we're really now holding Fortescue, Rio, BHP, Mineral Resources, and on the ETF side, having to think about OZR. Computershare under algorithm buy signals, strong performer. We continue to like Computershare and Link. NAB under buy signals. I don't get excited about the upside opportunity for the banks, given that in the recent results we saw almost 1% revenue growth, a little bit of cutting on the cost side of it that trimmed 1 or 2 percentage points off the cost, but overall I don't think the growth rate was terrific in the banks. It's hard to see over the next 12 months it being materially better. One of the positives for the banks is, as I said, the US interest rates moving a little bit higher. A little more inflation gives them allowance to increase margins on their loans. That's really what's driving today's buying in the banks, rather than sort of any definite pickup in earnings at the moment. So we'll continue to monitor that level of buying interest in the banks over the next week or two. But Westpac's in the model portfolio. Goodman Group, one of the better performing property stocks, but it is getting expensive. So unless interest rates fell again, and referencing the 10-year bonds in the US, we're unlikely to see Goodman really rally. I think that's they are likely to deliver 10 to 14% earnings growth over the next couple of years, so maybe the base case is more of a consolidation there in Goodman. Mirvac, we like, it's performed very well, as is Aristocrat Leisure, one of the better performing stocks in the model. Cochlear's had a subsequent buy signal. It was originally added back in late last year, and then we've got another round of buy signals. I've shuffled the support in there at around 220. ResMed, looking for this to pull back a little bit further and just be patient for the next buy signal, but it is one of the better performing stocks in the model. Treasuries performed well from that support there of around $10. You could even shuffle a support line up a little bit tighter there at 11.55, but we think Treasuries, there's room for that in portfolio. Stocklands in the model performing well. Insurance Australia Group's a recent addition. Wesfarmers, looking out 6 or 12 months, we think we get some level of normality returning to the Australian economy, and obviously Wesfarmers' earnings will be hit from the current lockdowns, but I think investors have shown a willingness to sort of look past the shorter term implications. So we continue to like Wesfarmers and certainly like their longer term e-commerce strategy. GPT's performed well since being added to the model, so the switch from sell signal into buy had it added into the model there at around $4.25. Still an alternative to owning too many of these REITs is the SLF, and we continue to hold that or the equivalent of. Sydney Airport's one of the better performing stocks in the model. Xero, one of our preferred technology plays. BHP, think about adding that down at these levels. Lendlease, you have to have a willingness to carry a bit of added risk here in your portfolio with Lendlease, but I think if we look out 12 to 24 months, you get a much better environment for Lendlease. The balance sheet's got very little gearing on it, so hopefully we don't get any surprises in regards to them needing to raise capital, but the outlook for Lendlease 12 to 24 months out from now should be quite strong. Tabcorp, not a lot in upside, not a lot in as far as growth or upside in the share price. Downside supported by the upcoming split. Being a buyer of it around this level, maybe even thinking about selling covered calls, a way of driving income. AZJ's been added into the model, buying that on the dip here. Next year's earnings will probably be only fraction or marginally higher than F year 21, but will be interesting to see if what we're looking at now is actually the beginning of a trough and a new uptrend developing over the coming years. But algorithm switch from sell signal into algorithm buy there at around that 360 level. Coles, so think about this within a range. If you're adding this to your portfolio, small amount here, small amount at low $16, end up with a blend in the middle there. I think that's about right. And from there you can think about either holding the stock, selling covered calls, or just maintaining exposure while it's under buy signals. Woolworths, so these consumer staples have been a little bit soft today as interest rates have increased. So as I mentioned, consumer staples and healthcare, there's been a little bit of selling. I'd be surprised if we saw Woolworths back down below, say, 37.50. So if you're creating a range and you were thinking about adding it, if you don't already own it, small amount here and then add to the position down around that $37. And that would really be a function of those 10-year yields in the US continuing to spike a bit higher, that you would see ongoing selling in those consumer staples. South32, one of the better performing stocks in the model. Northern Star's obviously been disappointing. We've been holding on to this for a while. We did cut most of our other gold exposure and really were left with Northern Star and Gold Road Resources as our two main gold exposures. Northern Star's definitely our larger weighted exposure within the gold sector. And we continue to be patient with this. I think hard to pick the exact turning point here, but I still think there's room for a Northern Star in portfolios, and we continue to hold that. Afterpay under buy signals, we got the acquisition there by Square. Woodside Petroleum, now energy's the strength of the market at the moment, so I'm reluctant to quit this from portfolios. So one of the strategies that I look at here is to simply stay long the stock as long as it stays above this 10-day average. I've flagged up here where I think we'd hopefully see a test of around that $24 level. We'll take a closer look at the Woodside exposure if we're to trade up to that level. And what we may find here in Woodside is, although it's under sell signals at the moment, in the coming months, if it had a rally and a pullback, it would then be added back into the model portfolio. But Woodside, we actually don't mind from a fundamental standpoint, so I'll continue to stick with that and wait for weakness before we cut it. Qantas under algorithm sell signals, and again, probably on a pullback, we see that shift to buy. Santos, likewise, under sell signals. Sonic Healthcare, need to be a little bit cautious on this. A fair bit of their revenue come from COVID-related testing income, and the market will start pricing in a falling off in that, and I think ultimately whatever that sell-off is ends up being a buying opportunity. So if we were to see Sonic down at around that $36, $37 level, I'd expect it to shift a buy signal and be added back in. Not doing anything in centre. Telstra we like, but up against resistance. Transurban, think about owning that if you're looking for income for portfolios. They've shored up the balance sheet with a recent capital raising. Suncorp, not doing anything there at the moment. Amcor, expect that to shift to buy signals soon, and I posted about that on the blog. Origin, I still think that there's maybe a recovery story there in Origin, 12 to 24 months out. QBE, not doing there at the moment. Dexus, these are now all stocks that are under sell signal. James Hardie, it will shift back to buy signal in the next 3 to 6 months, James Hardie, but there may be some weakness coming on those softer US housing data if we see a continuation of that sort of data that's been appearing over the last month or so. Ramsay Healthcare, income contributor to portfolio, not much in the way of downside for Ramsay. Likewise for ASX, income contributor, not much in the way of downside. Brambles, keep an eye on this. I think you'll see this switch to buy signals very soon. APA, not there at the moment. I will point out that a number of investment banks have upgraded their outlook for APA. Newcrest, preference Northern Star. CSL, I'll just pause and take a closer look at this. I do think that the pattern's in place to see a slightly deeper sell-off in CSL, and maybe it's back down to 275 and a switch back to buy signals, and at that point I'd think about adding it to portfolios. And there we are, back to the beginning. So to conclude tonight, I just want to go through some ETFs and discuss these as alternatives in the portfolio for a diversified exposure to investment themes. So the BetaShares Global Banks, so you can see there we got supported around that $6, a higher low there at $6.30. It's above the moving average. If you're wanting to play this theme at the moment where money's coming back into banks as a result of that interest rate moving higher in the US, this is one way to do it. You could certainly stay long this position, providing it stays above that 630 low or even that moving average. So just getting into a bit more of a shorter term trading thinking or approach there, but the consistency of how we approach shorter term trades should be clear. The Cure ETF, that's something. It is under sell signals, and we can see it's below the moving average, so you may want to just be patient and wait for that to reverse higher. But from a fundamental standpoint, I still think that the Cure ETF has a reasonably attractive upside to it. The Asia Technology, so this is gives you a basket exposure to the technology plays in Asia. So you can either think about this ETF, or the alternative that I prefer is the IAA, which is under algorithm buy signals, and that's a iShares top 50 throughout Asia, so not as heavily weighted to technology stocks. But you can see they're supported around that 109, and we're starting to increase our exposure into that at the moment. IZZ, again, our preference is through that IAA, but IZZ is exposure to China. There's a lot of negativity in the media at the moment around China, and generally you're not going to see a lot of positivity when you're buying something cheap. So if you're looking for a counter trend move, and just keep IZZ on your radar. OZR is the ETF, the resource ETF, so if you're looking for a basket sort of exposure, starting with BHP, Rio as the main weighted positions. The IHD was one that we touched on at the beginning, which was the iShares. This is the Dividend Opportunities Fund. You can see there it's under algorithm buy signals. I have created a band there. This could be a little bit soft if interest rates push higher. So this has a reasonable exposure into consumer staples. and healthcare. So just have a think about your allocation, but somewhere between 13 and 1370, I think there's room to consider adding that into portfolios. Food and fuel, I've already covered that earlier tonight. The ILC, just have a quick look at that. This is the iShares ASX Top 20. So you can see support there off that low of around $28. And there's the Vanguard. So this is the Vanguard MSCI International Shares hedged version. Support there at around that 85 level. If you want broad-based global exposure in your portfolio, that's one way to do it. And let's just have a quick look at this VanEck video gaming ETF as well. Support there at around that 1075. If you'd like to know more about the ETFs and to have a look at what's in the models, click on the model portfolio. Here's the list. So you got ASX 20, ASX 50. So when you look at the ETFs, click on all ETFs, which covers every ETF listed on the ASX. Click on days held, get the least number of days, and then you can see what ETFs have recently been added to our model portfolio. If you want to look at specific ETF providers, you can look at iShares, and I've covered a few of those tonight. So you can see the ILC, for example, was added 6 days ago. The IHD was added 18 days ago. The ISO, so they're all iShares. If we have a look at the other providers, so the VanEck ETFs, the most recent addition there was the Australian Banks ETF, which was added 69 days ago. And then ETFs as a product and a company that manages these listings, they don't have as many on the ASX as, say, Beta shares or iShares, so you're not going to see as many holdings in this particular portfolio, but they tend to do have done well since they've been added. So out of the 4, you can see the performance there. Probably more popular, the Beta shares and the Vanguard. So Beta shares have a large number of listings on the ASX, so you can see and the most recent ones added to the model portfolio there in the performance. And then Vanguard is one that you'd all be familiar with, and if we have a look at that, the Australian Banks ETF was added 69 days ago. The VanEck S&P Mid Cap, the World ex Australia Quality ETF, the property ETF, etc. So you can come in there, and you can also toggle through those charts for those, and look back at the historical performance of ETFs that have been removed from the model and what the percentage gain was and the number of days that were held. Thank you for listening in, and if you'd like to know more about either the